The U.S. housing market in October 2025 stands at a pivotal juncture. It is a period defined by significant shifts and emerging trends that demand careful analysis from investors, agents, and financial professionals alike. Key indicators reveal a market in transition, notably a slight dip in mortgage rates, now comfortably below the 7% threshold. This movement offers a crucial signal for market participants. Despite these positive shifts, a lingering sentiment of uncertainty continues to define the market landscape. Renewed interest is palpable, yet caution remains a dominant theme among both buyers and sellers. The market is no longer the roller coaster of recent years, nor is it a simple linear progression. Instead, it has evolved into a complex chessboard, requiring strategic moves and a deep understanding of underlying dynamics. Mortgage rates have experienced a notable decline, dropping from a summer peak of 7.18% to a more manageable 6.52%. This reduction marks a significant development for prospective homeowners. This decrease provides a much-needed glimmer of hope and breathing room for buyers who have been sidelined by elevated financing costs. It directly impacts affordability and purchasing power. Consequently, demand inquiries have shown a tangible increase, rising by 8% in September alone. This suggests a renewed appetite for homeownership as financial conditions improve. Refinancing activity has also ticked up for the first time since 2022, indicating that current homeowners are seizing the opportunity to optimize their mortgage terms. This reflects a broader market adjustment. To illustrate the affordability shift, consider a $400,000 home. The monthly payment on such a property has decreased from approximately $2,800 to $2,600, representing a substantial saving for buyers. Inventory levels are climbing nationwide, reaching their highest point since 2019 with 1.23 million listings. This expansion of available homes fundamentally alters market dynamics. This surge in inventory grants buyers a level of leverage unseen since the pre-pandemic frenzy. The balance of power is shifting away from sellers and towards those looking to purchase. Price reductions are becoming increasingly common across various segments of the market. Nearly 1 in 3 listings now features a cut to its original asking price, reflecting seller adjustments to new realities. The current market dynamic rewards patience for buyers, a stark contrast to the conditions of 2021 where hesitation often resulted in missed opportunities. Strategic waiting is now a viable approach. The national trend for home prices shows a 2% increase year over year, but the pace of growth has distinctly flattened. This indicates a stabilization rather than continued rapid appreciation. The national median sale price currently stands at $412,000. This figure reflects the broader market's current valuation, influenced by both demand and supply adjustments. The market is best characterized as experiencing a soft landing. This implies stability and a gradual rebalancing rather than a dramatic crash, which is a positive sign for long-term health. Regional variations in price trends are significant. Coastal cities like Los Angeles and Miami are experiencing a cooling period, with price growth moderating or even slightly declining. Conversely, modest upticks are observed in Midwest metros, such as Cleveland, St. Louis, and Kansas City. These areas often benefit from relative affordability and steady local economies. Sunbelt suburbs, including Dallas, Phoenix, and Tampa, remain overbuilt and highly price-sensitive. These regions are still navigating the aftermath of rapid expansion and speculative investment. Buyer sentiment has undergone a profound emotional shift. The fear of missing out prevalent in 2021 has been replaced by a fear of overpaying in the current market. A significant portion of prospective buyers, 47% of respondents, are actively delaying their purchases. They are waiting for further price drops or more favorable market conditions to emerge. Rate sensitivity remains a critical factor. A substantial 64% of potential buyers indicate they would enter the market if mortgage rates were to drop below 6%. Confidence has emerged as the new currency in housing. Buyers are no longer driven by urgency, but by a calculated assessment of value and future market trajectory. The South is experiencing a significant surge in inventory. Texas and Florida, for example, have seen listings increase by 30% year over year, creating a more buyer-friendly environment. In response to this increased supply, builders in the South are actively offering incentives. These include covering closing costs, providing upgrades, and offering rate buydowns to attract buyers. The West continues to grapple with an affordability crisis. San Francisco, for instance, maintains a median home price exceeding $1.2 million, posing substantial barriers to entry. Transaction volume in the West has collapsed, showing a 40% decrease. This reflects the severe impact of high prices and elevated interest rates on market activity in the region. The Midwest, in contrast, exhibits relative calm. It offers more affordable homes, steady demand, and comparatively mild competition, making it an attractive region for many buyers. The actions of the Federal Reserve remain central to the movement and direction of the housing market. Their monetary policy decisions exert a powerful influence on borrowing costs. The Fed raised rates 11 times since early 2022 in a concerted effort to curb persistent inflation. These aggressive measures significantly impacted mortgage rates and market activity. By October 2025, inflation has cooled to 2.9%, a positive development that provides the Fed with greater flexibility. This moderation is a key factor in the current market outlook. Policymakers have signaled a possible pivot toward easing monetary policy or even rate cuts in the near future. This forward guidance is closely watched by market participants. Economists forecast mortgage rates sliding towards 6% by January 2026, provided inflation continues to moderate as expected. This projection offers a clearer path for future affordability. The battlefield for sellers has fundamentally changed. The days of receiving multiple all-cash offers, often above asking price, are now largely a relic of the past. Homes are staying on the market for longer periods. The average listing time has increased to 46 days, up from 32 days just last year, requiring sellers to adjust their expectations. Sellers are now embracing concessions to facilitate sales. These include offering rate buydowns, covering inspection repairs, and even assisting with transfer tax coverage. This marks a return to a more balanced market, where negotiation is not only expected but often necessary. It signifies a healthier dynamic between buyers and sellers. Home builders have responded to market shifts by slowing new starts by 9% in the third quarter of 2025. This reflects a more cautious approach to new development. Despite the slowdown in new starts, projects already in the pipeline ensure continued strong deliveries into 2026. This will contribute to overall housing supply in the coming year. Builders are increasingly focusing on developing more affordable units, specifically those priced under $400,000. This strategy aligns with current buyer demand and affordability constraints. The luxury segment of the market is currently oversaturated and is correcting the fastest. High-end properties are experiencing longer listing times and more significant price adjustments. The rental market continues to demonstrate resilience. National rents have risen by 2.3% year over year, though this is a moderation from the 7% growth observed last year. Apartment vacancy rates currently average 6.8%. This figure indicates a relatively stable rental market, balancing supply and demand without significant oversupply. The rental market provides a crucial alternative for those delaying homeownership. It absorbs demand from individuals and families who are waiting for more favorable buying conditions. This steady demand for multifamily housing helps prevent a larger correction in the broader housing market. It acts as a buffer, maintaining equilibrium in the housing ecosystem. The housing market is supported by several positive economic factors. These include low unemployment, currently at 3.9%, and robust wage growth of 4.2%. Rising consumer confidence also contributes to a cautiously optimistic outlook. A confident consumer base is more likely to engage in significant financial decisions like home purchases. However, challenges persist, particularly for younger buyers. The resumption of student loan repayments and increasing credit card debt weigh heavily on their financial capacity. Affordability gains remain fragile until real wage growth consistently outpaces inflation for at least 6 consecutive months. This sustained improvement is necessary for true market strength. The psychology of the modern buyer has fundamentally shifted. Buying a home is now about planning and strategy, rather than panic or the fear of missing out. Today's buyers are highly analytical, leveraging data tools, insights from platforms like Redfin, and advanced AI mortgage calculators. Their decisions are data-driven and well-researched. These buyers are characterized by being informed, strategic, and patient. They are willing to wait for the right opportunity rather than rushing into a purchase. This psychological shift marks a significant maturity in a market once largely defined by emotion. It signals a more rational and sustainable approach to homeownership. Investors are slowly returning to the market, particularly focusing on single-family rentals and secondary markets. These areas often offer better yields and growth potential. Experts predict a gradual recovery throughout 2026. This recovery will be characterized by steady improvements rather than a rapid rebound, allowing for sustained growth. The recovery will be fueled by several key drivers: continued population growth, the ongoing formation of millennial households, and eventual rate cuts by the Federal Reserve. The expert consensus points to a soft landing currently underway. This year is viewed as a transition period, offering buyers their first real bargaining power since the pandemic. For buyers, the advice is clear. Watch the Federal Reserve's actions, not just the daily headlines. The Fed's policy decisions will be the primary determinant of future market conditions. Negotiate boldly. Buyers should confidently seek repairs, credits, and rate buydowns. The market now supports these demands, unlike the seller-dominated environment of previous years. Think long-term. Focus on stability, community, and the intrinsic value of homeownership, rather than seeking quick flips or speculative gains. This approach aligns with a maturing market. Forecast models project a gradual recovery that will extend through 2026. This indicates a sustained period of market rebalancing and steady growth. Total home sales are expected to rise by 5%, with inventory levels stabilizing. This suggests a healthier equilibrium between supply and demand. Mortgage rates are anticipated to slide closer to 5.8% by late 2026. This continued moderation will further enhance affordability and stimulate buyer activity. The year 2025 will be remembered as the year the market reset, not collapsed. It marks a crucial turning point towards a more sustainable and balanced housing environment. The American dream of homeownership is evolving, taking on new forms and requiring a more nuanced approach. The market is adapting, and so must its participants. Buying a home now demands a strategic approach. It involves understanding market data, meticulously reading trends, closely watching interest rates, and negotiating with clarity and confidence. A window of opportunity is opening, though it remains narrow. For those who step through wisely, equipped with knowledge and patience, significant advantages await. The next chapter of the U.S. housing market could offer a level of balance not seen in years. This equilibrium promises a more predictable and sustainable environment for all stakeholders.